At 10:04 a.m., Berlin was sold. Not to diplomats, not to armies, but to briefcases, silent, metallic, and filled with cash. Across the once divided city, a new invasion began. One without sirens or shots, just signatures. The wall had fallen, physically, emotionally, ideologically. But in its rubble, something unexpected stirred. Not unity, not peace, but profit. On that cold morning in 1990, American hedge funds, previously confined to whispers in New York and meetings in Midtown, were already wired into Berlin's unraveling fabric. They didn't wait for treaties. They didn't ask for permission. They had something more powerful than tanks: dollars. Within days, GDR housing blocks, once symbols of socialist permanence, were flipping hands like poker chips. The owners weren't locals. They weren't even European. They were offshore entities, shell companies, Delaware trusts, all backed by Wall Street capital seeking blood from the stone of post-Soviet collapse. One apartment block on Prenzlauer Allee, 60 units, no hot water, shared toilets, sold for the equivalent of $73,000. By summer, it was renting for 10 times that. The former tenants? Evicted. Displaced? Unnoticed? This wasn't colonization by rifle. It was acquisition by spreadsheet. No boots on the ground, only polished shoes on granite floors, far from Berlin. While the world applauded freedom, someone else rewrote the terms. History books would later call it transition. But behind the curtain, a quieter truth pulsed. East Berlin hadn't been liberated. It had been liquidated. This was the new war. No bullets, no barbed wire, just wire transfers. The Cold War ended at Checkpoint Charlie, but the next war, the one fought in silence, began with a phone call from Manhattan, the day money replaced missiles. Berlin blinked. The Cold War ended not with an explosion, but with a calculation. By 1990, the Iron Curtain had rusted. Moscow was unraveling. Prague was dancing in the streets. And Berlin, that divided scar of Europe, was now the epicenter of euphoric collapse. Yet beneath the flags, the champagne, and the chisel strikes against graffiti-stained concrete, a new battlefield emerged. One not charted by generals, but by bond traders. The world economy was shifting. Trillions in capital searched for yield. Central banks slashed rates to accommodate peace dividends. Deregulation swept across continents. Currencies, once anchored by ideology, were now floating, exposed, volatile, and ripe for manipulation. Germany, the newly reunited titan, promised to fuse East and West. The Deutsche Mark would replace the East's brittle currency. And Bonn, ambitious, perhaps naive, pledged a 1-to-1 exchange rate for all East German marks. A political move, an economic fantasy. Meanwhile, Wall Street watched with the detachment of a hunter eyeing wounded prey. East Germany, the broken half, had assets but no market. Real estate, utilities, land, factories, millions of square meters untouched by privatization, unmapped by capitalism, and priced for liquidation. Property laws were unclear, ownership records scattered, bureaucrats paralyzed. And amid the chaos, West Germany's government could only whisper stability while hemorrhaging control. In Frankfurt, banks braced for integration. In Washington, the IMF issued polite encouragement, but in New York, the calculators clicked with ruthless intent. To a hedge fund manager, East Berlin was not memory or morality. It was margin. A distorted market begging for arbitrage. The model was simple. Buy distressed assets before locals understood the rules. Use shell corporations to outmaneuver regulation. Flip everything by the next quarter. In a single sentence, one fund memo read, "Berlin is the largest distressed asset in Europe. Act accordingly." And someone in New York was watching. East Berlin stood like a mausoleum, gray, gutted, and exposed. Its factories no longer hummed. Its currency, the East German mark, was weeks from extinction. Apartments built by the GDR stood intact, but their value was undefined. A socialist relic dropped into a capitalist storm. For decades, East Berlin operated without market logic. Rent was regulated, ownership was vague, and most property had never been bought or sold. Everything was state-managed, which meant no one really owned anything, and everyone felt entitled to something. Then, overnight, ownership became a race. Under the Treuhandanstalt, the German trust agency assigned to privatize East assets, chaos reigned. Thousands of properties were auctioned, often without proper records, sometimes without clarity over who had the right to sell. A crumbling paper trail stood between entire neighborhoods and financial redefinition. In theory, the government promised to protect locals, preserve heritage, and prevent exploitation. In reality, it was overwhelmed. An East Berlin bureaucrat described it bluntly. We went from marks to markets in 1 quarter. We didn't even have computers. By mid-1990, the warning signs were loud. But West Germany was focused on symbolism, not systems. Chancellor Kohl promised parity and prosperity. The Deutsche Mark would lift the East. Investment would follow. The reunification would be smooth. But on the ground, the eastern state was bleeding personnel. Lawyers resigned. Registry offices sat empty. Judges refused to rule on disputes no one had precedent for. It was the perfect vacuum, not of ideology, but of information. And in that vacuum, the city's soul went up for sale. Vacant apartments, former government buildings, whole neighborhoods with unclear deeds, all fell into a legal limbo that could be bypassed, if you knew how. To East Germans, the future was fog. To Wall Street, it was formula. One investor said it coldly. There are buildings here worth $5 million, but they'll take $50,000 because they're scared. Pride met panic. History met high frequency. The GDR was gone, but its ruins were liquid. And Berlin was unguarded. He was 29. No German blood, but fluent in the language of arbitrage. Born in Chicago, trained in New Haven, baptized by Goldman Sachs. He read Goethe by candlelight and balance sheets by instinct. In Berlin, they called him a shadow. On Wall Street, he was simply known as the kid who saw it first. His name isn't famous. It was never meant to be. His fund operated quietly, offshore under 3 layers of trusts. But his plan was brutal in its elegance. In 1989, as the wall cracked, he boarded a plane with 2 suits and a single question: how do you value a city that's never been priced? What he found was chaos. Leaky roofs, burning documents, families filing ownership claims by hand. He rented a room in West Berlin, installed a fax machine, and began mapping the East by walking it. Block by block, brick by brick. Each building noted, tagged, photographed. His team, 2 Czech students and a British lawyer, filed claims faster than the government could review them. When a building's ownership was uncertain, he made offers anyway. Cheap offers, fast cash, no questions. Locals hesitated. He didn't. By spring 1990, he'd acquired rights to over 70 properties, from vacant factories to old GDR ministry buildings, all routed through Luxembourg, all financed by a syndicate of American funds hungry for post-Cold War returns. He wasn't alone. Others followed. Sharks once circling Tokyo now swam in the Spree, but he moved faster. While they waited for German reforms, he acted on German uncertainty. His fund memo read, "This is the rarest of windows, a first-world capital with third-world enforcement. Buy everything." Regulators dismissed him as reckless. Newspapers ignored him. But he didn't care. He wasn't in Berlin to be polite. He was there to prove a point. That capitalism, when unshackled, doesn't knock. It drills. He used proxies to bid on buildings, hired locals to claim residency, sent architects to mislabel floor plans, exaggerate square footage, inflate permits. Nothing overtly illegal, everything aggressively gray. One building cost $112,000. He flipped it for $1.6 million within 6 months. His creed was simple. If risk has a face, it's mine. He didn't plan to destroy a city. He only wanted to prove it could be bought. And Berlin, broken, bureaucratic, bleeding, never stood a chance. It began with a wire transfer. $7.3 million moved quietly from an account in Delaware to a bank in Luxembourg. From there, it splintered. $400,000 to a notary in Berlin, $250,000 to a fixer in Dresden, £1.1 million to a construction firm operating under a Czech alias. None of it illegal, none of it traceable without months of subpoenas, all of it precise. By noon, 5 apartment blocks had changed hands. The method was perfected. Identify undervalued properties caught in post-GDR confusion. Use local intermediaries to bid, foreign corporations to buy, and offshore trusts to own. Each layer insulated the fund. Each transaction exploited the chaos. German laws hadn't caught up. Privatization efforts were fragmented. Property disputes clogged courts, and no centralized database existed. This wasn't a loophole. It was a canyon. On the ground, elderly tenants were told new owners required market rate adjustments. Rent tripled. Many couldn't read the paperwork. Some didn't believe it was real. They had lived there for decades. But the law had shifted, even if no one explained how. One district office processed 140 real estate transfers in a week. A single shell company controlled 38 of them. Locals began asking questions. No one had answers. This wasn't isolated. U.S. hedge funds poured in $1.2 billion between 1990 and 1992, a fraction on Wall Street, a tidal wave in East Berlin. Entire neighborhoods were bought blind. One fund manager reportedly acquired 200 units without ever stepping on German soil. At its peak, the daily capital influx rivaled East Germany's remaining foreign reserves. The city's landscape changed in silence. One block in Friedrichshain, once workers' housing, flipped 4 times in 7 months. The final buyer paid tenfold the original price. Gentrification became a euphemism. This was conquest, priced in dollars. The German press began calling it Die Schattenübernahme, the shadow takeover. But even that arrived late. By the time the public reacted, the deeds were filed. The ink had dried. In New York, the trades were celebrated. Risk-adjusted returns in double digits. Harvard endowments invested. Pension funds followed. What began as speculation became strategy. Behind every anonymous doorbell in East Berlin, there was a spreadsheet in Manhattan. The city became a balance sheet, and its soul, collateral. In Berlin, they called it economic vandalism. On Wall Street, it was just Monday. By late 1991, the alarm bells finally reached Bonn. Reports piled on ministerial desks, whole neighborhoods owned by faceless entities. Pensioners evicted from buildings they thought belonged to the people. Parliament demanded hearings. The press began naming foreign funds. Locals marched. Signs read, "The wall fell. So did our homes." It wasn't just property. It was identity. The East had surrendered its system, its symbols, and now its soil. Regulators scrambled. Emergency measures were drafted. New property registration laws were debated at midnight. One proposal aimed to freeze all sales east of the Spree. Another called for a review of every foreign-backed acquisition. But the market moved faster than the law. Every delay was costly. Each hearing took weeks. Each loophole closed revealed 5 more. Funds began splitting assets across jurisdictions. One building owned by 4 shells, each registered in different countries. Legal whack-a-mole. In frustration, one Bundestag member declared, "We're fighting fighter jets with feather pens." The Treuhandanstalt, Germany's privatization agency, was overwhelmed. Staff turnover neared 40%. Internal memos warned of asset bleed beyond recovery. Foreign capital wasn't slowing. It was accelerating. Meanwhile, U.S. embassies deflected blame. Private market activity, they said. Not a matter of state. But behind closed doors, even American diplomats were stunned by the scale. The German Federal Bank tried to intervene, proposing tighter currency controls, even temporary capital restrictions. But the West feared looking like the East, autocratic, closed, anti-market. And so, nothing stuck. In city courts, lawsuits surged. Former East German families filed claims contesting the legality of post-unification transactions. Some won, most lost. The law favored those who moved first and paid in cash. Each attempted counterstrike cost time, trust, and political capital. And Berlin kept changing. Construction surged. Luxury renovations replaced socialist decay. Locals who once ran neighborhood councils now served as janitors in buildings they used to administrate. Germany had hoped for integration. What it got was acquisition. By the end of 1992, estimates showed that foreign funds controlled up to 30% of East Berlin's commercial property and 22% of its residential housing, figures unthinkable just 2 years earlier. No tanks rolled through Alexanderplatz, but it had fallen nonetheless. And the people, the ones who endured the wall, were left wondering how they lost everything in peace. Each defense came too late. The market was already inside the gate. The collapse wasn't loud. It was bureaucratic. Between 1990 and 1993, over 4 million East Germans applied to verify property claims. Less than half were resolved. Of those, thousands found that while they slept under their old roofs, someone else now held the deeds. Evictions began quietly, one notice at a time. In Lichtenberg, a pensioner returned from a clinic to find her door padlocked. The apartment had been sold months before. She never saw a mark of it. Rent caps vanished. Modernization fees were introduced. A single kitchen upgrade could triple rent. Protesters chained themselves to stairwells. Others simply vanished, moved out, moved west, or moved underground. But this was not only about homes. Schools were sold, factories dismantled, cultural centers bought, privatized, and flipped as nightclubs. Entire districts changed hands, often multiple times in under a year. By 1993, Prenzlauer Berg had transformed from gray decay to boutique capitalism. Locals couldn't afford their own neighborhoods. Streets that once echoed socialist slogans now displayed English menus and price tags in Deutsche Marks. The numbers told the story better than any headline. Over 2,400 East Berlin properties were acquired by offshore entities between 1990 and 1993. Of those, more than 60% were later resold within 24 months. One fund reported an internal rate of return above 40% annually. For context, that's wartime profiteering in peacetime. Job losses compounded the crisis. As old industries collapsed and Western corporations refused to absorb state labor, unemployment in East Berlin soared past 20%. Those left behind faced a paradox: liberated politically, dispossessed economically. The psychological rupture was deeper than any economist predicted. Citizens who once feared the Stasi now feared the landlord. Children grew up hearing tales of socialism and watching their parents sink into market-induced poverty. The new Berlin glistened, for some. For others, it eroded the memory of solidarity, replacing it with invoices and legalese. Public trust collapsed. Government approval in the East plummeted. Populist parties surged. One former GDR official called it capitalist colonization without the courtesy of a flag. Meanwhile, the hedge funds smiled. They weren't invaders. They were investors. Their names appeared in no newspapers, their profits registered offshore, their hands invisible. One of the largest flips? A decaying ministry building bought for $620,000, resold to a West German conglomerate for $8.5 million just 14 months later. It now houses luxury lofts. East Germany didn't lose a war, it lost a bid. The empire fell without a single shot fired. The silence after conquest isn't peace, it's paperwork. By 1994, the headlines had shifted. NATO expansions, EU treaties, new elections. But beneath the diplomatic triumphs, Berlin simmered with an irony too bitter to print. The people who cheered unification now paid rent to it. Friedrichs-Heinz cafes once served factory workers. Now they served American lattes to American landlords. Locals whispered in disbelief. The same block where Stasi officers once surveilled dissent now charged $2,000 a month for minimalist industrial chic. For the East, freedom had come with eviction notices. Former GDR officials vanished into history. But the architects of acquisition, fund managers, lawyers, brokers, found themselves profiled in Forbes, applauded for innovation, invited to economic forums on post-socialist transitions. One was even offered a teaching position at a university in London. Another was recruited by the World Bank. They never described what they did as exploitation. The term they preferred was market correction. In press interviews, they spoke in passive tones. The capital found its most efficient use. They never mentioned who it displaced. The numbers told a tidy story: returns, conversions, GDP growth. The ghosts didn't fit on the graphs. Germany attempted repairs. Rent controls were debated. Public housing projects revived. Local councils promised compensation. But the damage was cultural, generational. For every restored facade stood a forgotten story. A musician who lost her rehearsal space. A teacher forced out after 30 years. A family whose surname no longer matched the doorbell. The GDR had disappeared. But in its place, many felt only absence, not opportunity. One graffiti scrawled across a newly restored block read, "Freedom is expensive. We just didn't know the price." Meanwhile, in Manhattan, the original fund manager retired early, 43 years old, bought a vineyard, still owns a dozen Berlin buildings, through holding companies, of course. In New York, they called it Historic Alpha. In Berlin, they just called it loss. Berlin was just the beginning. What happened there? The swift privatization, the legal ambiguity, the foreign acquisition, became a model, a playbook. By 1995, hedge funds were applying the Berlin template to other cities, cracked open by transition. Prague, Budapest, Warsaw. The game was no longer secret. It was scalable. This wasn't war by invasion. It was war by invoice. The language of conquest changed. Colonies became portfolios. Front lines became property lines. Shell companies served as new battalions. And treaties were replaced by term sheets. Germany responded eventually. Laws were passed. Ownership records digitized. Foreign capital faced stricter reporting. But Berlin had already changed hands. And the funds didn't need to stay. The profits were already booked. The city's legacy was twofold: a warning and a roadmap. Economists praised the efficiency. Political scientists warned of the social rupture. But the market didn't care. Berlin's transformation was proof that capital, when unregulated, moves faster than governments, faster than people, faster than memory. The Treuhandanstalt, once heralded as a bridge between systems, became the most hated agency in post-war Germany, accused of selling national assets to foreigners at fire sale prices. One study estimated that of the 14,000 enterprises privatized, over 85% were sold to Western buyers. Less than 10% remained in Eastern hands. And still, no one went to jail. The U.S. funds that orchestrated the Berlin sweep expanded operations globally. Latin America, Southeast Asia, Eastern Europe. The same logic, the same tools, the same result. Berlin had proven a brutal truth. Empires no longer fall to armies. They fall to algorithms. Capitalism didn't rebuild East Berlin. It rewrote it. The cobblestones remained. But beneath them, the deeds told a different story. A silent power shift. From states to markets, from citizens to shareholders. And in that shift, a new empire was born. Invisible, stateless, ruthless. It flew no flag, but it owned the buildings where the old flags once hung. Wars without bullets still bleed the world dry. Berlin was not bombed. It was not besieged. Yet by 1995, entire districts bore the scars of conquest. Not from tanks, but from title transfers. No parades marked the shift, no memorials captured the silence. But behind every renovated facade, every polished lobby, every foreign-owned asset, lay the remnants of a population that once believed freedom would mean belonging. Instead, they were bought out of their own revolution. The West celebrated reunification. The East lived its consequences. Not as citizens of a new Germany, but as tenants in their old lives, governed not by politics, but by property. This is the quiet empire. It doesn't declare war, it declares ownership. It moves not with soldiers, but with spreadsheets. It does not demand territory, it extracts value, and it does not retreat. The Berlin story isn't unique. It's a prelude, a prototype for what would follow, in cities and countries where collapse left space and capital filled the vacuum. Today, the same forces circle new ruins. Wars end, markets begin, and behind the ruins of ideology, another auction always waits. What shocked you more? The speed, the silence, or the fact that no one called it theft? History won't remember the names of those who bought Berlin, but their signatures remain, etched into deeds, offshore ledgers, and balance sheets. Freedom arrived, but so did the invoice, subscribed to shadow empires, where money became warfare.